Welcome to Unit 3. In Unit 3, students will develop the skills necessary to record the opening balances on a balance sheet in a T-account ledger. They will be able to analyze transactions to determine which accounts are changed and whether the changes are recorded as debits or credits. Students will learn how to record transactions in T-accounts, and they will be able to calculate the balances in those accounts. Based on the account balances, they will prepare a trial balance to verify the mathematical accuracy of the ledger. Based on these trial balance figures, they'll be able to prepare a balance sheet from the trial balance. Currently, in Chapters 1, Units 1 and 2, we learned that items on the balance sheet change as business transactions occur. We learned how to use a transaction analysis sheet in order to take a look at individual transactions and see the effect on the individual accounts. This shows one method of determining which accounts increase or decrease. To make the point that the left side of the balance sheet equation, must always remain equal to the right side. That was why we used the transactions sheets. How many transactions would a large firm be likely to make in one working day? Let's take a look at what the transaction analysis sheets could possibly look like if a company that had many transactions on a daily basis, what would their transaction analysis sheets look like? Well, here's a page full, and we've got 1, 2, 3, 4, 5 transactions. 1, 2, 3, 4, 5, 6 transactions. 6 more. You can see that it's very impractical to use transaction analysis sheets in the real world. There are thousands and thousands of transactions, and the number of numbers that you would have to write down is just not practical. How does a business know how much each customer owes? A business keeps an account for each and every customer and keeps an account for each type of transaction. What is an account? What's the definition of an account? The definition of an account is a form in which changes caused by transactions are recorded. You need to know this definition for any tests. For every item on a balance sheet, an account is prepared. So if you recall, all the asset accounts, liability accounts, and owner's equity accounts, each of those has to have its own account. As transactions occur, changes are recorded in these accounts. So we can see on this screen here an example of Goldman's Gym, their balance sheet of June 30th. All these items highlighted in red are accounts, and these are the ones that are affected by day-to-day transactions. First of all, we have to learn about T accounts. T accounts are shaped like the letter T, hence their name. They must have a title. There must be two sides, a debit side and a credit side. And here's what it looks like. Notice the account title. Notice the shape of the T. Notice on the left side of the T, underneath the top line, we have the debit. And on the right side, we have the credit. Now it's at this point that I like to tell a little story. Let's pretend you're taking a new language, and the new language is Martian. And the word in Martian for left side, or left, is debit. And the word for right is credit. When you are talking about debits and credits, I want you to think of them as just a new name for left and right. There's no other definition needed. A debit means left. A credit means right. Write down in your notes on a piece of paper. An account is a form used to record changes caused by transactions. Also write, there is one account for every item entered on the balance sheet. Now we need to talk about the ledger, or the general ledger. The definition of a ledger is a group of accounts. That's it. It's a bunch of accounts together in one place. Data for each account is kept separate from other accounts. It may be written on paper in a binder for a manual accounting system, or it may be stored electronically for a computerized accounting system. Now we have to talk about opening the books of a company or a business. To open accounts in the ledger, these steps should be followed. First of all, we have to place the account name in the middle of each account. We have to record the date and the opening balance, which we get from the balance sheet, and make sure that we put this balance on the appropriate side of the account. Total debits must equal total credits. So the balances, all the debit balances, when they're totaled up, must equal all the credit balances when they are totaled up, once all the accounts have been entered onto the ledger. Now we have another definition, double entry accounting. The definition for double entry accounting is, for each transaction, a debit amount equal to a credit amount must be recorded in 2 or more accounts. That's it. So when you're asked on a test, what is the definition of double entry accounting, this is what you would write. All transactions are recorded in 1 or more accounts as a debit and in 1 or more accounts as a credit. That's why we call it double entry accounting. The total of the debit amounts must equal the total of the credit amounts. In your notes, I would like you to draw a T account, like the one I'm about to show you. Include a title, and then label the debit and credit sides. So here we go. Include a title, put account title. On the left side, we put debit. On the right side, we put credit. Please do this now. Pause, and then when you're ready to go, resume. Welcome back. Okay, now we're going to turn into the textbook on page 51, exercise 1. We're going to do this together. I'll help you go through this. Remember that exercises are found in your workbook. We're going to use the general ledger set up for us on page 19 of the workbooks. So this is for Dominicana Restaurant, and this is a general ledger for that company. Notice the T accounts are set up. We've got cash, supplies, land, building, equipment, accounts payable, mortgage payable, and Xavier Diaz capital account. Write all these accounts down and pause, and then when you've finished, resume. Now we have to record the opening balances based on the balance sheet in the textbook. As of May 31st, there was $5,000 in the cash account. Well, we know, because of our debit and credit knowledge, that assets have a debit balance. So this $5,000 is placed on the debit side of the cash account. Supplies is on the debit side of the supplies account. Notice we write the date and we leave a space, and then we put the balance in that account. Land is $40,000 debit. The building is $200,000 on the debit side. Equipment $50,000 on the debit side. Accounts payable, because this is a liability account and liabilities generally have a credit balance, we put this amount along with the date on the credit side. So May 31st, the balance for accounts payable is $16,000. Mortgage payable, the balance is $84,000. And the capital account, it's an equity account, the balances there are always on the credit side, $205,000. Now I'd like you to read from page 37 to 40 and then do questions 1 to 5 on the GP Accounting 11 blog site and then exercise 2.